So for my next guest, it's clear that growth is slowing, right? I think we all kind of see that, but also the pace of inflation. But he does not see recession, in part because the stimulus is still out there in the system, fixed rate debt, and the return of M2, which had taken a major turn lower. I want to bring in our DoubleLine Capital Deputy Chief Investment Officer, Jeffrey Sherman. So, Jeff, let's start with that. No recession. That's nowhere on your bingo card right now. Nowhere on the near-term horizon.
Well, at least for 24, right?
Okay.
I mean, it's always looming out there, and there's some probability of it. But as you pointed out, I think we have to remember all of these stimuli, what they did to the overall economy. And so we focus so much monetarily, but there's still the fiscal stimulus in there. And so you'd reference M2, and you're talking about it hooking back up a little bit again.
And we got a chart here right between us, just a sort of, it made a precipitous move lower.
Yeah.
And that was actually where a lot of people were making that recession call based on that.
Yeah, well, in history, when we've seen a contraction in M2 year over year, it has led to a recession. But remember, there's very few data points that exhibit that. But what you're missing in this chart is going back 3 years or so. And if you look at how much the increase in growth was, we increased the monetary base by more than 30% during 2021 or 20 and 2021. And so from that standpoint, that money still sits out there somewhat. And so even though this chart shows it accelerating again, what you're missing is that long-term trend. And that long-term trend, we are still way above that. And that's what's kind of juicing some of these asset prices as well. Now, the Fed always focused on this whole excess savings concept, right? And you and I talked about this in LA earlier in the year, right? You said, give me some of that, right? There's excesses. I want some, too. I've been using that phrase, by the way. I credit you with it. But the thing about it is that we don't know what sits out there still in people's bank accounts. We have seen rising delinquencies. And what you notice when you see that is it's affecting the young, it's affecting the bottom income, and it's affecting the bottom FICO cohorts. So this is usually where stress builds in the system, right? Inflation is a regressive tax. And so we're starting to see some of those impacts there. But Charles, I could have been saying this still for the last 12 months, right? And so we're seeing it kind of work through the system. The data has slowed in the last month or so. So we don't like to say one data point makes a trend. You need 2 or 3. But at this stage, it's a little early, we think, to be calling for that recession, at least in 24.
So where does this leave the Fed, particularly when this sticky inflation is still an issue? I know there's always a lot of rationalization over, shelter and how long the lag is. But you and I also were talking about the supercore CPI, which unfortunately I don't think the financial media talked enough about because in that CPI report, that continues to spike higher.
Right. Well, it's not accretive to the Fed, right? It doesn't support the narrative of cutting rates, and so no one wants to talk about it. But this is why the Fed, you say, where are they? I think it's rock and hard place, right? They want to cut. They were signaling that. The market started to really pressure them. We had as many as 7 25 basis point cuts priced in the market in January of this year. And here we are roughly 1.5 or so. And so what's changed the dynamic is the inflation data has not been supportive of rate cuts. Absent the last CPI report, the previous 3 were spiking the other direction, or they were missing to the upside. And so I think the Fed wants to see, kind of a reversal of that. I want to see 3 or 4 more of those kind of prints be accretive, but that puts you right before the election, right? So in general, I think that the Fed, it has to be on hold really throughout the summer, and then they're probably just going to wait for the election anyway. So betting on a rate cut over the course of the summer, I think, is a futile exercise because we need to see the data improve meaningfully. And I heard your previous guest talking about unemployment rate going up, but the unemployment rate has been somewhat stable. We've seen a lot more immigration. We've seen more job placement there. And so as you look at the overall path, it doesn't really look like unemployment is significantly on the rise. So
then I've only got 30 seconds. I know in your note you said T-bill and chill, still a good way to go. And also your thoughts, though, on the stock market, which rallied initially on those 7 rate cuts you talked about. Then the narrative changed, but it was always still good. Hey, don't worry about rate cuts. If the economy is strong, then the market's going to be strong. And now that the economy is beginning to wane, the street would love to get back onto the rate cut bandwagon, but they can't. Now it looks like all eyes are on NVIDIA after the close.
Yeah, so try to summarize all that real quick, right? T-bill and chill, you got time to chill, but you don't have much longer to chill if the Fed is going to cut. So you can still build portfolios. You can go out there. You can find things that yield 6, 7, 8% on the credit side, mix it with some interest rate bets, and all of a sudden you have a portfolio that yields 6 that outstrips that T-bill. You're going to have to build that portfolio soon if you don't already have it. For the equity market, I mean, the narrative had been rate cuts, but what you see is it's still mega cap that's driving the overall market, right? The interest rate sensitive sectors have been struggling. right? Look at the small caps, look at that middle market lending kind of area, the places that have that floating rate debt exposure where they're going to have to pay higher coupons for a longer period of time. So those are areas still struggle. So remember, we're being engulfed by the mega cap effects. I know all eyes are on NVIDIA. I mean, who wants to short NVIDIA today? I mean, no one really wants to bet against that. And I think what you've seen is tech has done really well in earnings this quarter, and I don't see why NVIDIA wouldn't do the same.
Ride the wave.
Ride the wave.
My man.
All right, great to see you.
Seeing you. Always great to see you.
Pleasure.